Do you ever wonder how a big tech company posts great results and raises guidance when everyone's talking about AI disruption and economic headwinds? Today, we're taking a deep dive into Workday's latest results, their fiscal 26 Q2, and what their plans tell us about, well, their strategy for growth. Okay, so let's unpack this. Workday just dropped their Q2 numbers, and right off the bat, the headline figures look really strong. Total revenues, $2.348 billion. That's up 12.6% year over year. Solid. But for a company like Workday, subscription revenue is key. And that climbed even faster, 14.0% to $2.169 billion. What really jumped out at me, though, wasn't just the top line. It was the profit. I mean, operating income more than doubled. It went from $111 million last year to $248 million this quarter. Huge leap. And if you look at the non-GAAP figures, the ones that strip out things like stock compensation, give a clear operation picture. Non-GAAP operating income was $680 million. That's a, 29.0% margin. Very healthy. Even the earnings per share numbers look good. The $0.84 JAP, or $2.21. Non-GAAP, solid increases there too. That profitability jump, though, more than doubling. That seems, well, pretty significant for a company this size. What's that telling us about how they're running the business?
Yeah, it's fascinating, isn't it? It's not just that they made more money, it's how. Seeing both GAAP and non-GAAP operating income grow that much faster than revenue. That really points to improved efficiency, operating leverage, basically. They're getting better at turning those sales dollars into actual profit. And like you said, the non-GAAP numbers are helpful here. They sort of cut through some of the accounting noise, stock comp, some acquisition cost to show that underlying operational strength. So what does this mean for you listening? It signals a company that's managing its core business really effectively, even while it's still investing in growth, financially quite healthy.
Right, so it's efficiency gains, not just more sales. That makes sense. And looking ahead, those backlog numbers seem pretty staggering too. Their 12-month subscription backlog is what, $7.91 billion, up over 16%, and the total backlog is massive, $25.37 billion, up almost 18%. Plus, solid cash flow, $616 million operating, $588 million free cash flow, both growing nicely. What does a backlog that big, growing that fast, really tell us? Does it give them more predictability than maybe some other software companies?
Oh, absolutely. Those backlog figures are crucial. They represent future revenue that's already locked in, contracted. So yes, it's a huge indicator of predictability. A nearly $8 billion 12-month backlog, a $25 billion total backlog, growing in the mid-teens, that shows incredible customer commitment. Stickiness. Customers aren't just signing up for a year. They're in it for the long haul with Workday. And that kind of predictable recurring revenue, it's gold in the software world. It gives them a really solid foundation to keep investing. And the strong cash flow just underlines that. They can fund their R&D, fund acquisitions, whatever they need internally. That's a powerful position.
Okay, so Q2 looks great, but the real confidence test is always the forward guidance, right? What are they actually projecting now?
Exactly. And this is where it gets really interesting. They didn't just meet expectations. They actually raised their outlook for the full fiscal year 26. They're now calling for full-year subscription revenues of $8.815 billion. That's about 14.2% growth. And they're keeping that strong profitability outlook, too, projecting a non-GAAP operating margin of around 29.0%. For Q3 specifically, they're expecting subscription revenues of $2.235 billion again, about 14% growth, and a non-GAAP margin of 28.0%. So raising both the top line and the margin guidance, that's a pretty strong vote of confidence from management, wouldn't you say, especially with all the market uncertainty out there.
That is bold. What's underpinning that confidence? Are there specific strategic moves driving this?
Yeah, there definitely are. The CFO, Zane Rowe, he actually mentioned that this new guidance includes the impact of the Paradox acquisition, which, they expect to close later this quarter, so they see that adding value pretty quickly. They also boosted their cash flow outlook for the year. Operating cash flow now guided to $2.85 billion and free cash flow to $2.65 billion.
Right.
That free cash flow number is up 21% year over year. Huge. And that cash generation allows them to do things like buy back shares. They repurchased nearly $300 million worth this quarter alone. The CEO, Carl Eschenbach, he basically put it down to momentum from their AI innovation, their platform strategy, international growth, and the partner ecosystem. They feel like they're really well positioned.
Okay, so strong financials, strong confidence, but what's the secret sauce here? What's practically fueling this? We hear AI all the time. Is that really the main engine for Workday?
It's a real core part of the story, yeah. And they're really pushing this idea that their AI is built in, not bolted on, meaning it's integral to the platform. And it seems to be more than just talk. They said over 70% of their core customers are already using Workday Illuminate. That's their AI piece for analytics and planning. But maybe even more telling is the ACV, the annual contract value from their AI products. They said net new ACV from AI more than doubled year over year this quarter.
Wow, doubled.
Doubled. Yeah. And they're landing big names with it too. Trinity Health, Chipotle, Cox Health. So customers are clearly seeing value and, importantly, paying for it.
Is that AI push all homegrown stuff, or are they buying technology too? And how does that make the platform, stickier?
That's a great point. It's actually a mix, a pretty smart blend. They've made two key AI acquisitions recently. One is Paradox. That's a conversational AI tool focused on the hiring process, candidate experience.
Right.
It costs about $1 billion in cash. They see it helping create this really powerful AI-driven talent acquisition suite. Think natural language for interacting with candidates, especially for high-volume hiring, frees up HR teams. The other is Flowwise, which is more of a low-code platform for building AI agents. And yes, this deep AI focus absolutely makes the platform stickier. It enhances the core applications people rely on. We're also seeing proof in things like Workday Extend that lets customers build their own apps on the platform. Its new ACV also doubled year over year. And the Workday Marketplace, their app store basically now has over 100 apps that's also doubled since the start of their fiscal year. It shows a really vibrant ecosystem building up around them.
Makes sense. So AI is clearly huge. What about other growth areas? International partnerships?
Absolutely critical. International is a major growth driver for them. They called out strong performance in Europe, particularly the UK and Germany, and also continued momentum in Japan. And a really significant strategic move is their big push into India. They appointed a new president there, Sunil Jose, and they're committing to building a local data center. That signals a long-term play. And the partner ecosystem, also crucial. It sourced over 20% of their net new ACV. Think partnerships like Daily Pay for on-demand wage access, or their agent partner network involving companies like AWS and Google Cloud. It really extends their reach and capabilities. Plus, they're still landing big new logos like Carrefour and Banamex and expanding with existing giants like Google and Nationwide. Oh, and interestingly, Salesforce, which has used Workday for HR for ages, apparently just went all in on Workday financials in their accounting center too. That's a big endorsement of their unified platform strategy.
Okay, so strong results, raised guidance, clear growth drivers. Yet the stock dipped a bit after hours when they announced all this. Is that just the usual market weirdness, or are investors maybe a bit nervous about something? Valuation maybe, or future growth? I even heard an analyst on the call ask about this kind of, quote, pure psychosis, that maybe AI startups will kill off SaaS companies like Workday. How are they addressing that sort of sentiment?
Right, that's a key question. And the CEO, Eschenbach, he tackled that head on. He basically said the idea that AI will disrupt their seat-based model is, quote, completely overblown for Workday. He pointed to their massive entrenched customer base, over 11,000 customers, more than 65% of the Fortune 500. And their gross retention rate is in the high 90s. Very sticky. His point was that customers actually see investing in Workday as part of their own AI strategy. Workday isn't the disruption, it's enabling the transformation within these critical business functions.
So Workday becomes the AI enabler, not the victim.
Exactly. They're building AI into the tools businesses already rely on, making those tools better, rather than being replaced by some external AI point solution.
Okay, that makes sense. What about just general economic worries, tariffs, geopolitical stuff impacting overseas markets?
Yeah, they acknowledge they're watching all that, of course. But they said they haven't seen significant, quote, blowback so far. Like I mentioned, performance in the UK and Germany was strong, despite, potential headwinds there. They did mention some specific softness in the U.S. state and local government sector, SLED. They call it mainly due to funding uncertainty. But even there, they managed to win some big competitive deals, like the University of Virginia. So resilience even in tougher spots. Overall, the message from management was that the, quote, selling environment has been pretty consistent for the last year. They feel like they're executing really well in this sort of new norm and are confident about the second half of the year. They seem to have found their rhythm.
Okay, so wrapping this up then, it really sounds like Workday's executing a pretty complex strategy quite well. They're leaning hard into AI, expanding globally, building out their partnerships, and it's translating into strong financials and, maybe more importantly, the confidence to raise their guidance. Seems like a good example of an established player navigating these tech shifts effectively.
Absolutely. Which leaves us with maybe a final thought for you to chew on. In this world of constant tech change and market flux, what is Workday's approach integrating AI deeply into core systems, nurturing those long customer relationships? Tell us about what really creates durable growth in enterprise software. Is it all about disruption, or is strategic evolution the key?